We're kicking off today's market recap with a comment that has traders recalibrating their rate playbooks heading into the second half of 2026. Former Federal Reserve Vice Chairman Roger Ferguson said over the weekend that it wouldn't surprise him to see a rate hike before year-end, a statement that lands like a thunderclap against a backdrop where consensus had penciled in rate cuts beginning sometime in the third or fourth quarter. The bond market is already reacting in complex ways, and with the Nasdaq 100 down 4.8% today and the VIX sitting at 18.70, the stakes for getting the rate call right are enormous. This is the story that frames everything else in today's session. Roger Ferguson, former vice chairman of the Federal Reserve and one of the most credible voices in central bank policy circles, made a pointed observation tied directly to the May jobs report. The labor market's resilience may justify a rate hike rather than a cut by year-end 2026. This is a stark deviation from the market's base case, which had priced in a hold pattern through mid-2026 followed by easing. Ferguson's framing centers on inflation persistence and labor market strength, the same two variables the Fed has repeatedly flagged as conditions for holding or hiking. The 10-year Treasury yield stands at 4.53% today, down 0.18%, while the 5-year sits at 4.26%, down 0.37%, suggesting markets aren't fully buying the hike thesis yet. What makes Ferguson's comment structurally important is not just the man saying it. It's what it signals about divergence inside the broader Fed policy community. The consensus dovish lean has been the anchor for equity valuations and bond positioning throughout this year. If a respected former official is openly comfortable floating a hike scenario, it raises the probability that current Fed members harbor similar doubts about cutting prematurely. The May jobs report is the specific data linchpin here. Strong payroll additions, persistent wage growth, and stable unemployment would all validate Ferguson's logic. That shifts the calculus on the entire rate curve, not just the front end. The 5-year yield at 4.26% suggests the market is still anchored to an easing bias, which means a hawkish repricing could be sharp and fast. The rate hike scenario hits different parts of the market in very different ways, and today's price action already tells the story. The Nasdaq 100 is down 4.8%. Megacap growth names carry long-duration earnings streams that get crushed by higher discount rates. Long-term treasuries, the long treasury ETF and TLH, covering the 7 to 10-year bucket, face direct selling pressure if the 10-year pushes toward or beyond 4.6%. On the other side of the ledger, financials stand to benefit materially. JP Morgan and Bank of America both see net interest margin expansion in a higher for longer or higher outright environment, and both are names to watch closely. The Russell 2000's gain of 1.29% today reflects small cap rotation away from rate-sensitive big tech, a pattern that would accelerate if Ferguson's scenario gains traction among active FOMC members this week. The single most important variable to monitor is whether the 10-year Treasury yield breaches 4.6% on any hawkish repricing event, or conversely falls below 4.4% if incoming data softens the hike narrative. Either move would have cascading effects across equities, credit spreads, and volatility. The VIX at 18.70, down 13.06% today, is arguably too complacent given the policy uncertainty Ferguson introduced. A sustained shift in rate expectations could send implied volatility surging again. The S&P 500 faces resistance at elevated levels, and that ceiling holds only if the rate narrative stays relatively benign. Watch Fed speakers lined up this week for any echo of Ferguson's hawkish framing. A second credible voice endorsing a hike scenario would materially accelerate the repricing. Ferguson's rate hike comment is a minority view today, but minority views from credible former officials have a history of foreshadowing consensus shifts, especially when the underlying data, in this case a strong May jobs print, supports the argument. Investors holding duration in long-term treasuries and TLH should be aware that the asymmetric risk is to the downside if the labor market confirms resilience this week. Growth equities, already bleeding in the Nasdaq 100 today, remain exposed to any further hawkish signal. Financials in JP Morgan and Bank of America represent the cleaner hedge. Higher rates lift their earnings directly. Gold provides the inflation hedge backstop regardless of direction. That's the full picture on the rate hike debate for today. Coming up, a story moving a major sector that investors simply cannot afford to ignore. Shifting now from equities to commodities, Because a geopolitical pivot in Washington is rewriting the cost structure for your morning cup of coffee and the companies that sell it. Arabica coffee futures have surged to record highs after President Trump withdrew threatened tariffs and economic sanctions against Colombia, one of the world's top coffee-producing nations. That reversal has sent traders scrambling to reprice Colombian export flows, eliminating a supply chain disruption premium that had been baked into prices for weeks. The move is significant not just for commodity traders, but for every packaged food and beverage company with Colombian bean exposure on its input cost ledger. Here is the precise sequence of events. Prior to Trump's tariff withdrawal, consensus among commodity desks had priced in sustained elevated coffee costs tied to Colombian trade friction, with analysts estimating meaningful supply disruption risk if sanctions had taken hold. The market had also been modeling an estimated 0.34% margin compression for packaged food companies exposed to Arabica input costs. When the tariff threat was formally pulled back, Arabica futures broke to record highs as traders reversed that geopolitical risk premium in a single session. The velocity of the move underscores just how much fear premium had been embedded in prices over the preceding weeks of escalating rhetoric between Washington and Bogotá. The deeper macro significance here extends well beyond coffee prices themselves. Colombia is a critical node in the global Arabica supply chain, and any sanctions regime would have constrained export volumes at precisely the moment when global coffee inventories were already tight. What markets were pricing in was not just a tariff surcharge. They were modeling potential export restrictions that could have cascaded into broader CPG cost inflation. That inflation signal was also being transmitted into the 10-year Treasury, which sat under pressure as food price inflation tends to re-anchor broader CPI expectations. Today, the 10-year yield has pulled back to 4.53%, reflecting in part the reduced inflation risk that comes with this tariff rollback. Let's name the names. Keurig Dr. Pepper carries direct Arabica exposure through its core coffee business and stands to benefit most visibly from normalized Colombian supply and lower forward input costs. Nestlé, with its Nespresso and Nescafé franchises, faces a similarly favorable repricing on its commodity hedging book. Altria has consumer staples exposure that also responds to the broader input cost relief narrative. The Consumer Staples ETF Consumer Staples is the cleanest expression of this theme at the sector level, as easing commodity headwinds improve margin outlooks across packaged foods and beverages. Discount retailer Walmart also benefits as grocery cost of goods sold compresses, potentially supporting guidance upgrades when Q3 numbers are reported. Several levels and catalysts deserve close attention from here. First, Arabica futures themselves. Record highs invite profit-taking and consolidation. So watch whether prices can hold or whether the initial euphoria fades as traders await confirmation that Colombian export volumes actually normalize. Second, the 10-year Treasury at 4.53% is approaching key support levels that become technically meaningful if risk sentiment continues to improve on the tariff relief narrative. Third, gold at 4,352.00 is holding its ground despite the geopolitical de-escalation, suggesting broader safe haven demand remains intact. That divergence is worth monitoring. And critically, any reversal in the U.S. Colombia diplomatic posture would immediately reignite Arabica volatility and pressure Keurig Dr. Pepper and consumer staples again. The bottom line is straightforward. The Trump administration's withdrawal of tariff threats against Colombia removes one of the more concrete input cost headwinds that had been quietly compressing margins across consumer staples all quarter. Consumer staples and names like Keurig Dr. Pepper and Nestlé now have a cleaner path to margin expansion in Q2 and Q3 2026 earnings cycles. The key risk is diplomatic reversibility. This White House has demonstrated it can re-escalate as quickly as it de-escalates, so position sizing matters. Use any pullback in consumer staples as an entry. Keep one eye on the 10-year at 4.53% and watch Colombian trade headlines closely. Those are the two stories that matter most this Monday morning. Full breakdown is up. If this kind of deep dive market analysis is useful to you, hit subscribe and turn on the notification bell so you never miss a daily recap. We break down every major market moving story with the source numbers and specific tickers you need to trade with conviction. See you tomorrow.